Good morning everyone and welcome to today's Howden and Searches UK webinar, jointly hosted with Jenny Screech of Howden's PII. What we'll do is, if you have any questions throughout the webinar, there is a questions pane or a chat pane for you to ask any questions you may have. If you could all let me know that you can hear me loud and clear, and you can see Jenny's presentation, that would be great. And what I'll do is I'll hand over to Jenny. Thank you very much.
Thank you, Sam. Thank you for that introduction, and thank you for the opportunity to present the webinar today. As you'll see from the title, Solicitors PI in Challenging Times. Now, I think if we all had a pound for the number of times we've heard the phrase challenging times in the last 12 months, we'd be very rich indeed. But it does certainly remain an apt description of what we're seeing at the moment in relation to Solicitors PI. Just by way of background, I am a legal professions executive with Howden Insurance Brokers. I have been involved in the Solicitors PI market since 2000. Prior to that, I was a solicitor in private practice, but I have been engaged in Solicitors PI initially as a claims solicitor at the Solicitors Indemnity Fund and then at Zurich, then as an underwriter for a number of years at Zurich Insurance, leading the Solicitors Professional Indemnity team as legal professions manager. And then more recently, I have switched codes 4 years ago to the broking side of the business. So that's the background that I bring to the seminar today. What I want to do is just give you a market update, just to let you know what's currently happening at the moment. It's useful to start with just a review of Solicitors PI in 2020, what we saw, and then we can talk about what we expect to see for 2021. Obviously, we have the 1st April renewals underway at the moment, so we have got an early look at what's happening. We're then going to have a look at issues that are currently troubling underwriters involved in Solicitors PI, and then go on to some tips for renewing in the current market. So let's look at 2020. Now, if any of you saw yesterday's Law Gazette, there's a PI supplement in there. And the headline for the PI supplement is Solicitors face hardest PII market for 20 years. And again, I've noted here, hardest market since the Solicitors Indemnity Fund. Now, I think it's useful to actually put this into a bit of context. Let's just go back more than 20 years to those last couple of years of the Solicitors Indemnity Fund, and the total premium pot for your compulsory insurance was, for the last 2 years, in excess of £300 million. I acknowledge that that does include the extra cash calls. In the first year of the open market, it dropped to 155 million, so almost halved. We collected data in terms of the total premium pot right through until 2015-16. And it was at that point that the information wasn't collected further because it wasn't needed for the assigned risk pool. But what we do know is that over that period, there were only 3 years that the total premium pot was above 250 million, and one of those years was a 13-month policy. So effectively, we're looking at 2 occasions in that period, despite the fact that we had the compulsory limited indemnity double during that time, claims inflation, and certainly more firms being covered as well. Where the market is at the moment, we can only take an educated guess, but the view is that it has clearly returned to a level that is above the 300 million, but would certainly be, in our view, below 350 million. But it's important to note that, you know, it's taken over 20 years to get back to that level. It's also important to note that the hard market's not unique to solicitors PI. It is affecting other professions as well. The surveying community in particular are having considerable issues, not just with high premiums, but also the ability to get cover, particularly those that are involved in cladding issues and fire risk assessments. So with that backdrop, if we look at what happened in 2020, we saw increases in rate on both the primary and the excess layer premiums. Looking at the primary market first of all, and it was in August last year that the chair of the Law Society PI committee went public and said that firms should expect increases of up to 30% in terms of rate, or more if they had claims issues. Now, to be honest, that wasn't a bad stab at the numbers. Number of firms did have increases in that level, but many firms were able to conclude their PI renewal with rate increases below 30%. For some, it was higher, particularly if they had challenged claims experience. As far as the excess layers are concerned, that's where we have seen an even greater movement, and the rate in relation to excess layers has gone up by 50 to 100%. Historically, excess layer, we're talking here top-up insurance, it's the layer above your primary 2 and 3 million, and historically that has always been very, very keenly priced. But what we've seen in the last few years is an increase in the quantum of claims that have been out there in the market, and that has really started to hurt insurers who have been playing at that level. And that's what has prompted the price increases. In addition to that, there are insurers who have left that particular market, so capacity is also an issue, and obviously that's something that drives rate as well. Given the increases that firms are seeing, a number of firms are questioning whether they actually need their excess layer cover. We would urge caution with that issue. It's really important to be mindful of what your regulatory obligations are, and it's clause 3.1 of the SRA indemnity insurance rules that requires firms to have adequate and appropriate insurance. And that's adequate and appropriate insurance taking into account both your current and past practice. There's some very useful guidance that the SRA put out as to what adequate and appropriate insurance means, but it is important that firms consider that issue and document the decision that they've made regarding their need for top-up cover or otherwise in case the SRA come knocking and looking for evidence that the issue has been properly considered. 18-month deals. Now, in recent years, the 18-month deals have become very popular, but limited appetite for them in 2020. Just to give you an example, when we went into with the Howden book the 1 October renewal last year, we had 17% of the book on an 18-month deal that were just finishing an 18-month deal. Only 1% renewed on that basis. There were two issues at play here. Firstly, a number of insurers were reluctant to offer 18-month deals, and where they did, it was generally with a premium rate uplift for the final 6-month period. And given where premiums were, it was also an affordability issue for a number of firms. We also saw primary insurers reducing limits of indemnity. So where, for example, historically, a primary insurer may have been prepared to offer a 5 million, 8 million, or even a 10 million pound limit, we saw a number of insurers wanting to reduce those back down to the primary level. We also saw increases in the self-insured excess that insurers required, and in some instances they were imposing an each and every excess in relation to perhaps certain areas of practice or certain claims. Claims arising from buyer-funded development work is a particular issue that I will talk about in a moment. And that was an area where we saw, for example, an insurer that might impose a 10K excess aggregated 3 times, except for any claims related to buyer-funded development work, where it might be 10K each and every claim or claimant. So it's important to beware that those issues are at large as well. Limited appetite for new business, and that's particularly the case where conveyancing was involved. Insurers were looking to limit the amount of conveyancing work as a percentage of the overall fees. And in many instances, we saw that around the 20 to 30% level. If a firm was undertaking conveyancing above that level, then if they didn't like the terms that they were receiving from their existing insurer, it could be actually, in some instances, quite challenging for them to get alternative quotes. So where did it end on the 1st of October? There was a preliminary report on the numbers that entered into the extended policy period. Those were firms that weren't able to secure their renewal by the 1st of October. And in November, we see a report from the CEO of the SRA to the board, noting that 47 firms had self-reported as being in the extended policy period. However, that seems to me to be somewhat understated, because having a look at the SRA numbers since then, we know that in September 2020, there were 83 firms that closed. In October, there were 57, and November 35. Now, not all of those will have closed because of the inability to get their PI, but it's reasonable to expect that that will certainly be the case for a number of them. So with that backdrop, we then move on to look at the position. If I can move my slide, there we go. What to expect in 2021? Well, the hard market unfortunately isn't over yet. We are still seeing premium increases coming through for the April renewals. The good news is that no participating insurers have left the market. New business appetite remains an issue, particularly for firms that are engaged in conveyancing. So, again, we've seen a further retraction on that as well. Whereas in October last year, we had a situation where, as I mentioned, insurers were wanting to limit conveyancing to 25 to 30%. That's come back down even further, and in recent weeks we've had insurers, a number of insurers, saying no more than 20%. So that remains an issue. Still limited appetite for 18-month deals. We don't expect to see a significant number of those this year. Very lengthy proposal forms and pandemic-related questionnaires. Now, for anybody who renewed on the 1st of April last year, you probably dodged the pandemic-related questionnaires, because we didn't go into lockdown until the 23rd. So it was really at the point of the October renewal that we saw significantly more questions that were being asked by insurers. And those questions relate to issues such as the firm's financial position, how they're handling remote working, what they have in place as regards cyber security, what risk management procedures they have in place to address the additional challenges that we're facing as a result of the pandemic. Also expect very significant scrutiny of the financials. Now, there is a backdrop to this because in about July last year, before the October renewal, a number of participating insurers went to the SRA and said, we'd like you to change the rules. We want to have a situation where we only have to provide the 6 years runoff cover when a firm closes if the firm pays the premium. We also want an amendment to ensure that in those circumstances where an insured firm doesn't pay the self-insured excess, that we don't have to pay it either. The SRA rejected that request, and their view was that they certainly didn't want to reduce consumer protection, and they agreed to work with insurers from a regulatory perspective, but there was certainly no will to change the minimum terms and conditions. That led to insurers scrutinising financials of firms quite closely at the October renewal, because their concern is that to the extent that a firm fails and is insolvent, they will need to pick up that 6-year runoff cover and any unpaid self-insured excess. It also resulted in a couple of insurers requiring personal guarantees from principals in LLPs and other incorporated practices in some instances. So that is something to be mindful of as you move towards your renewal this year. The other issue I just want to flag for 2021 is an issue that you're going to hear quite a bit more about in the coming weeks and months, and that is what is known as silent cyber. Silent cyber is the term that's used for potential cyber exposures, where the cyber coverage in the policy wording is neither explicitly excluded nor included. The concern is that this potentially leads to ambiguity, lack of clarity, and policy disputes. So it was in 2019 that the Prudential Regulation Authority and Lloyd's said to insurers that this issue needs to be addressed in the insurance market generally. It has resulted, probably, it's fair to say, in the cyber issues being more often excluded in PI policies as opposed to included. But obviously, when it comes to solicitors, we have minimum terms and conditions. The participating insurers via the IUA put a proposed exclusion clause to the SRA recently that has been rejected. The SRA were concerned, once again, that it reduced consumer protection. However, we know that it is an issue that the SRA are looking at, and they are considering some drafting to address the issue. So it's important that firms have that on their radar, keep talking with their broker about it to understand what it means. Our view is that there will need to be a consultation before any changes are made, so certainly firms should keep an eye out of that. But it's also actually a catalyst for firms to have a think about cyber cover as well, because a cyber policy will cover more than a PI policy when it comes to cyber losses arising from cyber incidents or cyber security issues. The SRA published last year a thematic review on cyber security, and they had undertaken that review with 40 firms. 30 of them were firms that had experienced a cybersecurity incident themselves, and the additional 10 had been engaged with clients who had experienced a cyber attack. What we found interesting was that over the 40 firms, there were only 12 that actually had separate cyber cover. So if you multiply that out across the profession, it seems that there are a number of firms at the moment that don't have separate cyber cover. And certainly since the pandemic, we've seen a very significant increase in cyber attacks. And it's certainly something that firms need to consider going forward, and something that we would recommend firms talk to their broker about. So moving on, issues that are troubling the PI underwriters. It's always useful to understand what the pressure points are, because that informs you as to what extra information you might want to put in your proposal form to address the fears that the PI underwriters have at any given time. Conveyancing is at the top of the list. There's a very high incident of claims activity. There always has been. I was looking recently at some of the old CIF data, and conveyancing was the most significant cause of claims back in CIF days, and certainly looking at the open market figures, it's exactly the same today. Buyer-funded developments and other investment transactions, that is certainly an area that's caused a great deal of issue in the last 18 to 24 months. PI underwriters have paid out millions and have millions in reserves to meet these claims. So that is a very sensitive area, and what you will see in proposal forms are significant questions relating to development work generally, but also the buyer-funded development work where the deposits that are being paid are higher than the usual 10%. In some cases, we're looking at deposits up to 80%. Now, some of these developments have proceeded and been completed satisfactorily, but some of them have failed spectacularly, and some of them have been fraudulent. And obviously, when purchasers have bought into a development that doesn't proceed, they will cast about for where they can recover their losses, and we know that as a result of the very broad NTCs, solicitors are a target. So that is very much an issue that is headlining for our PI underwriters. They're also concerned about the impact of the stamp duty relief. They are concerned at reports as to the pressure that conveyancers are under due to the amount of work that change has generated. And what we've seen historically is when people are busy and under pressure, mistakes do happen, and that gives rise to claims. They're also concerned about what the result will be when the relief ends. Now, obviously, we had a bit of a reprieve on that last week, but the concern is that to the extent that a purchaser misses out on the stamp duty relief because their transaction doesn't complete in time, there is a risk that the solicitor's file will be picked over to look for any issue of delay there that might have impacted the situation. And where that is found, it is reasonable to expect that complaints or claims may follow. Also, in the conveyancing world, we have issues related to multiple dwellings relief. We have not a flood of claims arising from that, but it is an issue, and we are seeing claims coming through. Escalating ground rents or onerous ground rents, that continues to be an issue. It hasn't been the catastrophe that was predicted back in 2017, but it is creating some claims activity still. Also, the cladding issue. An issue that is something that's more significant for the surveying community, but it is another complicating feature in relation to the transaction of properties that are in multi-occupancy developments. So another risk issue that insurers have their eye on. And they also have a concern about the uncertainty regarding the future outlook for the property market. Now, I think they can be challenged on that, because certainly there's a lot of evidence at the moment that the property market is buoyant, and there's a lot of commentators saying that they expect that to continue even after the stamp duty relief ends. So that's something that is obviously going to be a wait and see. But what we do know is that when there's a fall in the property market, there is an increase in claims activity against solicitors in relation to conveyancing issues. Next, moving on to other issues, underwriters have got a concern about the pandemic being a catalyst for further claims activity. We've talked here about cyber. That's something that I have mentioned, and at Howden we certainly have seen more claims activity arising as a result of cyber incidents. There's a concern about wills, probate and estate administration. This is something that underwriters have been talking about for some time now. They are seeing more claims coming as a result of wills, probate and estate work. And that is both in terms of frequency and severity. And obviously there is a concern that the complication of the pandemic may exacerbate that with urgent instructions being given, with complications in relation to the execution of wills, despite the fact that the rules on that have changed. There's still potential for concern about that. Missed time limits is another issue that they have on their radar, to the extent that fee earners have been furloughed or people have been working from home, whether time limits will have been missed, limitation dates, etc. Also, the undersettlement of litigation has been raised as a potential concern. The issue there being whether potentially cash-strapped claimants may have undersettled litigation simply to get a deal done and get the cash in the door, and when remorse sets in, they may then turn to pick over the advice that was given to them, resulting in an issue for the solicitor. Commercial contracts, to the extent that you have a disappointed party because a contract has fallen over, again, they may be looking to unpick the advice that was given to them to support a claim that the contract hadn't been drafted sufficiently robustly. So all of these issues are, as I say, there are potential for increase in claims activity. Cyber is the one area where we have seen it, but looking at our experience at Howden, we're not frankly seeing too much else come in that we can genuinely say, well, that's happened because of the pandemic. However, we do know that claims against solicitors emerge slowly, so it is very much a wait and see. And it's important to be mindful that the issues are on the radar for your insurer. And then finally, again, the risk of law firm insolvency and closure is something that insurers are concerned about. So finally, just to move on to some tips as to how to deal with the current market at your next renewal. The first thing I would say is stay informed. Really important to keep talking to your broker and find out what's happening, what they're seeing, and to discuss with them a timeline for the work that's needed in relation to your renewal, because as I say there, one of the important issues is to start early. There's a lot of work to do. There's a lot of information, as I've indicated, that insurers are requiring. Proposal forms always take longer to complete than you expect, and this year they're going to take longer than ever. Really important to invest time in that renewal proposal. Your PI is a very significant spend, and it certainly justifies spending a significant amount of time to make sure that your presentation is as best it can be. Now, I know that some of the questions on the proposal form can seem tedious. Sometimes it's not always obvious why a question is being asked. Sometimes the question may not be particularly clear, and I would really encourage firms in those situations, just pick up the phone, have a chat with your underwriter, and if you really understand what the insurer wants to know and why they're asking the question, that will help you to provide the best answer that you can. We also find sometimes that firms don't record the information in the same way that the question's being asked. And again, in that scenario, talk with your broker, because it may be that you can present the information in a different way, or presenting what you actually do have and providing some narrative around that will actually nonetheless address the issue. Representation, choose your broker wisely. It's really important to ensure that you have a broker that is a specialist in the market. The Law Society have put out an extremely useful PI buyer's guide, and it was last updated in September last year. And there's quite a lot of guidance and information on that about choosing your broker and the sort of questions that you should be asking your broker. It's really important to understand what markets they have access to and what markets they have direct access to, because not all brokers are able to access all markets, and sometimes they need to involve another broker to do that, which can create an extra layer. Also, another point that we would say is, don't feel that you need to just stick slavishly to the completion of the proposal form. Complete the proposal form, but also feel free to include a covering letter or a supplementary document that gives some information about your firm that is important but may not necessarily be evident in the proposal form. For example, it might be that you have introduced some new risk management procedures. It might be that the management structure has changed within the firm. It might be that the firm is looking at taking a different direction over the next 12 to 24 months. Just a 2 to 3 page document that provides the underwriters some additional information can actually be really useful in helping to set your firm apart from the masses. The information will be read, but as I said, underwriters are looking at hundreds of submissions, so not War and Peace. Two to 3 pages, bullet pointed, something that that is easy to read. Also address the issue of premium finance early. Most markets are either cash with order or you have to have an irrevocable offer of finance. And the premium finance providers are asking more questions this year as well. So certainly don't leave that too late. You need to have that well in place in time for the renewal date. And the final point that I would make is just to say that risk management is absolutely key. That at the moment really does need to be front and centre of what you're doing. It's something that insurers will want to see coming through in your proposal forms. So keep that in mind as you complete the documentation, and really do your best when it comes to those questions where you need to provide the narrative information. Make sure that your answers are as clear and risk focused as they possibly can be. So that completes the slides. So Samantha, if I can come back to you to see if we've had any questions that have come through that I can assist with.
Well, at the moment, Jenny, we've not had any questions from any of our live attendees. What we can do is, to anyone that does have a question, by all means, you can email marketing@searchesuk.co.uk, or what we can do is, Jenny's kindly put her contact details on the screen now. So if you would like to email Jenny, that's absolutely not a problem. Just to make you all aware, is that okay, Jenny?
Absolutely fine. And just one thing there to add, Samantha, we put out a market report in January this year, which does cover actually a lot of what I've said. So if anybody would like access to that, you're very welcome to drop me an email and I will get it to you.
Perfect. Just to make all attendees aware, the session has been recorded and you will get a copy of the webinar via email afterwards. I think it will take about an hour or so. If you don't get it, by all means, send me an email. I'll get that across to you as soon as possible. I hope you've all enjoyed today's webinar. Take care and we'll speak to you soon. Thank you so much. Take care. Bye.
Thank you, Samantha. Thank you.